The madness of the housing market and Bitcoin. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone and welcome back to another episode. If this is your first time tuning to NOVARISE Invest, let me tell you, this is your channel for financial education. So it is that time of the month again. It is the very first of the month, and what we're going to do is to go over a series of events of everything that has been happening over the last month and help you prepare for whatever is upcoming this particular month. And for that, what we're going to do, we're going to go straight into the tablet and analyze what's going on in the market today. And here we go. Our first stop is this article right here. And as you can see very clearly, the US housing prices are pushed to record highs, slowing down the pace of the purchase. In fact, if you take a closer look up here, we're seeing that the cost for existing properties are up 19% in April from a year early, right? And as you scroll down, we will take a look at the very first paragraph right here. So America's home buying frenzy is cooling off for the first time since it's heated up last year as limited inventory and record high prices are excluding potential buyers. So we're actually getting to the point where housing is becoming so expensive that the bottom line of the housing market, meaning the ones that used to be more affordable, are now becoming basically unaffordable for those families who are trying to fulfill the dreams of owning a home and, having that American dream of being homeowners. And on this following paragraph, you will see that the existing home sales have fell 2.7% in April from March. And April has marked the third straight month decline, the longest downward stretch since last spring when COVID-19 related lockdowns eased and have boomed in the past. Now, let me just clarify, the demand is still there, right? As you can see, the low mortgage rates are still existing and there's a rise in demand of housing, mainly because people are actually migrating basically from anywhere. The tendency used to be that people are actually moving from very condensed and jam-packed cities into suburban areas because they're actually looking for more space and so on. But then as you're scrolling down to this article, you will find out that that is not the only case. Yes, it is true. Families are having more flexibility when it comes to working from home. Some of their children are actually still attending school remotely. So there's a high demand for remote space. But you will be surprised to see that there are in fact people taking advantage of the opportunities of migrating back into the cities just because the rents are actually gone down. And that became an opportunity for those who are looking for quote unquote affordable housing and still be close enough to the metropolitan areas. So now back to the article, as you're scrolling down, there's this one section that actually called out my attention. Many brokers also hope that increasing vaccinations and the losing of federal and local restrictions will encourage more homeowners to listed properties. What does that mean for you? You might wonder. It means that the safer people feel, the more houses are going to be hitting the market. Why? Because one, people are feeling more comfortable on letting people come back into their houses and start looking and doing open houses and stuff like that without having the fear of exposing their families to the virus. And second, let's say homeowners are not afraid of list their homes anymore because the expectation is as more homes are hitting the market, that means more supply in the market, which hopefully will start driving some of the prices down. And the families who were afraid of listing their homes in the first place because they thought that once they sell the house, they were going to wind up being homeless because of all the madness with the pricing. Now they don't have to fear that anymore because once again, the more houses are hitting the market, that means the lower the prices, hopefully, will be, and therefore they're not going to get outbid by their competitors. They can sell the houses comfortably and then still have the cash available and the time available to look for another housing because there will be more availability for them to pick the housing that they want. And then another reason, another explanation that this article shares about why sales are actually slowing down in volume, it's because aside from the low inventory, builders are actually not building new homes either because of two factors. One, lumber prices or raw materials in general are ridiculously expensive. And even if they're actually willing to pay for that raw material, there's not much available in the market for them to compete and get access to. So that is actually delaying the whole building process. And then in addition to that, because of everything that's happening with the stimulus, some workers have found it more, let's say, beneficial or more advantageous to actually stay at home, not join the forced market yet because they are getting assistance through the unemployment and various stimulus that the government have been issuing. And they're realizing that if they stay home, one, they are staying safe. And then second, they are actually making more money than, going back to work. So that is actually adding to the problem, fueling to the problem. So now we have really high prices. We are pushing out the buyers who have a less of a budget because now houses have become too expensive for them to even afford to buy a house. We have low inventory because people are not willing to list their home. And then also we're having the lack of supply because home builders are actually not building their homes fast enough, and then we don't have enough housing hitting the market as of yet. And then as you scroll down, you will see here, okay, the big story is the housing markets that all constrained on buildings. And then as you scroll all the way down, it says here, which caught my attention. So if you happen to be a house flipper or a builder and you're still trying to look for a market to tap into, there's a section right here in the article that talks about a market in particular, and that is the country's faster moving housing market in April was Indianapolis, where the typical home went under contract after only 4 days, according to Redfin Corporation. So now if you're looking for an area to invest, that's your go-to area. And then for those who still have a decent budget and you can still afford to compete with other buyers if you're looking for the dream home, although I wouldn't recommend you to jump into the market right now if you're looking to buy properties to invest. But if you are looking for a home where you want to raise your family, or why not just simply take advantage of the low rates of the mortgage that you recently got pre-approved for, there is a trick. Kendra Mahoney and Kevin McGrath made 3 successful offers to buy homes in the Boston suburbs before getting one accepted in April. For the house they bought, they viewed it the first day and it was on the market and brought in an inspector with them to the showing, Mr. McGrath said. That helped them feel comfortable putting in an offer that didn't require a home inspection to make their bid more appealing to the seller, and the sale closed in May. So now if you are worried about competition, about getting outbid by other people, you can work on a more appealing offer, not necessarily bidding more money. You can still afford to make a lower offer as long as you create a win-win situation for the seller. And what do sellers typically want? Well, they want to close on their homes faster. They don't want to deal with the banks. And if they have to deal with the bank, they want to make this a pain-free process. So if you can make the home inspection process a lot easier on them, then hey, you got yourself a nice offer accepted. And by this, I'm not saying that you should waive the home inspection altogether. What this article is suggesting that if you want to create a win-win situation and make your offer more appealing, and therefore get faster closing, that you should go to the open houses with an inspector with you readily available. So the minute that you're doing the open house and you're walking around the house, you're having an inspector on site with you, saving you time because they're just simply walking around and looking at the structure of the house, or like picking on anything that will require negotiation, or just simply having the inspector giving you the green light and saying, you know what, this house is perfect the way it is. Feel free to make your offer. And then you can go ahead and present that to the realtor and just simply say, hey, we don't have to go through the inspection anymore because I'm actually getting it done right now. And we love the house. We want to make an offer and have a faster closing. That will give you a competitive advantage in comparison to other potential buyers out there in the market. So that's it for this article. If you are interested in reading this, as usual, I will leave all the links to the articles down in the description box below, so you can actually go through the article yourself and get more insights about the subject. So now moving along, let's just go on to the next article that we have here. Once again, the fact that the lumber prices are actually going up are not a surprise anymore. But this article in particular talks about what could be the potential solution to fixing this problem, right? So once again, as we scroll down, North America sawmills can't keep up with demand, which has sent wood prices on the rise. And you cannot expect new mills to start popping up though, because according to the conventional wisdom in the commodities business, the cure for high prices, in this case, the high prices of lumber, is in fact high prices. Why? Because when high prices for raw materials rise, refiners and smelters ramp up, farmers plant larger crops, and wells are drilled and mines and dug, and therefore new supplies are going to flood the market, and that's when the prices are going to start retreating, meaning they're going to start slowing down, which kind of makes sense because if you come to think of it, the less of a product available in the market, the more people compete for that specific product and they're willing to pay more. An example of this is the housing market. So it's the same analogy here with lumber. But if you start flooding the market with a lot more supply with a lot of that same material or that same product, then now all the vendors are going to have to start competing with one another so that they can get rid of their inventory. And the best way to compete with one another, assuming the materials are the same, it's with pricing. People will always want the best bang for the buck, and they'll always go where prices are cheaper if the product is the same, right? Now, as you scroll down, it talks about the home buyers and do-it-yourselfers who are willing to pay up to more than 4 times the normal price, but that is actually in fact offset with the rising home values, which will give them more equity and more appreciation, government stimulus, and also the historical low cost of borrowing money because we're getting a lot of cheap money thanks to the low interest rates that we have gotten. And then as you scroll down the article, you're going to see that there are some mills out there who are considering building new mills to generate more lumber and then hopefully fix the supply problem that we're having. But they are facing other issues out there because besides the time and money that it takes to build a modern mill and equipment and all that heavy machinery, there are other issues in hand, such as the lack of available workers who have found it more profitable to stay at home and collect on the government stimulus than actually getting back to work, right? And aside from that, the U.S. wood manufacturing industry is actually being extra careful because they are afraid of exposing themselves to risk and then having another 2008 fiasco repeat itself because there's one section right here, as you can see, U.S. product manufacturing peaked in January 2006, according to the Federal Reserve. A sharp decline that year before shadowed the housing market collapse. So it seems very familiar. It sounds very familiar. It seems like we're actually heading there. The wood prices are actually going up. The market is actually trying to find ways, trying to find solutions to supply more of that wood, more of that lumber available. But then you have to be careful because once you start oversupplying and the demand drops, then we have another issue. And in fact, there are a lot of middlemen somewhere down here in the article that I read that are actually afraid. Companies that buy wood from mills to distribute to builders, manufacturers, and resellers have been limiting orders to exactly what customers need in fear of getting stuck with high price inventory and failing prices. So the prices are really high up or really expensive. And even if builders or people in general are willing to pay for it, you cannot find more of that product, in this case, the building materials. And all they got to do is just to let the industry be itself and let high prices continue to go up until more supply is flooding the market. And then hopefully that will drive some of the prices down, right? Now, moving to the next article, this is just another article that I found online that is going to help you corroborate everything we just talked about in the past two. One, that the housing prices are extremely expensive, and that has driven the market to a drop because, more and more people cannot afford to buy houses available. And then you add to that, the issue with the lumber supply and the fact that there's no available workers out there. All of it creating a massive madness, right? Now, moving along, let's just switch the topic a little bit and let's just talk about what type of investment, well, real estate investment, is actually recession resistant. And that is the single family residence, right? Anything that has to do with single family, whether it's on the rental side or whether it's on the home buying side. Because if you come to think about it, everybody needs a home to live in, whether you can afford to buy it or whether you can just simply afford to rent it. But everybody needs a roof over their head. They need to come home, they need to unwind, they need to sleep so that they can be ready and then just head out to work the next day. Or if you're working from home, then even better, right? You need that roof over your head. Otherwise, you wouldn't be able to function. So what this article in itself is talking about is how low the default rates are on mortgages that are actually pertaining to single family residents. So let's say, for example, regardless of the industry that you're in. And if you're a homeowner, for example, you will go the extra mile to take care of your home and you will do whatever it takes to take care of it so that you won't lose it. And a similar rationale applies to single family rentals. Why? Because single family rentals are performing. People are doing whatever it takes to remain at home, to keep their family safe, even if it's a rental. And that translates to the landlord collecting the rent on time. And therefore, that same landlord will go ahead and make sure that the mortgage payments are taken care of. And this way, everybody is happy. So there you go. For those who are afraid, who were considering real estate market, but then you weren't exactly which route to go, whether the multifamily, whether apartment buildings, or a single family home, even though you will be owning one by one. Now you know that this type of investment, the single family residence, are in fact proving to be recession resistant, right? So this is a very short read. I'm going to leave the link to the article down below so you can actually check it out. Now, moving along to the next article so you can actually understand what exactly I was talking about in this original article right here. So people are moving. Period. End of the story. That's a fact. You cannot change that. And the belief used to be that more and more people are living the big cities and actually migrating to areas where there's more space, more bang for your buck, right? Because you have the extra bedroom that you can use as a home office, or you can have the extra room for the kids, or the playroom, or the gym, you name it, right? And you can get a lot of that for a lot less price plus a yard. That was the belief, right? But now, according to this article, it turns out that Gen Zs and the younger generations are either moving with their parents, or those who don't want to move back with their parents are actually considering leaving the suburban areas, leaving their parents' home, or just simply moving from one area into another big city because they're trying to take advantage of the concessions that are available. Remember, as a lot of people moved out of the big cities, landlords, they started to offer concessions so that they can attract the tenants. Remember, some rental income, it's better than nothing, right? So with the concessions and the lowering of the rent, they started attracting the younger generation, or those families who are actually looking for more affordable housing. And as it turns out, a lot of people are actually moving back in the city just to take advantage of all of those deals. So what this article is referencing to is that the renters, they're moving regardless, right? And there's a flow of traffic, a migration of renters from either one of the industry, people trying to leave to the big cities into the suburban areas, and vice versa. So if you're doing your market analysis and you're actually considering, or you're not sure exactly where to invest, now you know that regardless of which direction you go, you will have opportunities for your rentals. It's all a matter of how you're actually marketing that rental for those particular families. So, and another thing that is worth mentioning amongst this entire mess of, the expensive housing prices and, renters moving back and forth, just remember this. As housing prices continue to go up, there will be a lot more demand for rentals. Why? Because people, as much as they want to own homes, they are realizing that they cannot afford it. And renting becomes a lot more affordable, and it's not the end of the world. As long as you have a roof over your shoulder, your lifestyle can adjust, right? Because some generations, some families are actually thinking, hey, I'd rather rent and still afford to go out and hang out with my friends and take a vacation here and there, as opposed to, hey, I want to buy this ridiculously expensive house, call myself a homeowner, but I'm going to be house poor and then just be locked up in the house, right? Some people are okay with that. Some people are enjoying that lifestyle because they love to host. They love to having friends and family come over to their place. But some other families are not like that. And that is the beauty about real estate, right? It is extremely versatile. There's always a product or a housing or a market that will meet your expectations or whatever lifestyle is it that you're looking to achieve. Okay, very nice and interesting article. Definitely take a look at the description down below. Now, moving along to the next article. And this is one of the ones that caught my attention the most as I was researching. The Treasury Department, it's giving out $6 billion to assist landlords and renters, and more money, it's on the way, right? And then as you scroll down the article, they talked about how overall, altogether, the Congress has allocated more than $45 billion to clear up the enormous arrear racked up by renters after a year of historic unemployment. And even as the public health crisis fades, more than 1 in 7 adults renter in the U.S. still say that they are behind. And if you are a landlord, fear not. This article also talks about assistance available for the landlord who is dealing with a difficult tenant who is not willing to pay, or maybe just simply dealing with a tenant who truly lost their job. Maybe they got sick, they got furloughed, and they haven't been able to get back on their feet because maybe they are still sick, or maybe they just simply cannot afford to leave their children home because they cannot afford a babysitter. And therefore, you are, as a landlord, you are struggling as well to get access to financial assistance. If you are in that situation, all you got to do is just to scroll just right before this picture of notice to vacate. You will see this section where it says more than 360 programs across the country are giving out federal rental assistance. The National Low Income Housing Coalition has a list of them on their website. So all you got to do is just to access the link to this article, and then you will see this section where it says a list, and then you're going to click on the list and you will see a new tab opening. Treasury Emergency Rental Assistance Dashboard. In response to COVID and its economic fallout, many cities and states have created an expanded emergency rental assistance program to support individuals and families impacted by the pandemic. And then as you scroll down, you're going to start seeing the list. To make it easier for you, all you got to do is just to, search by state, territory. Just click on the search box down below, and then the type of programs that you're looking for. And then as you're scrolling down, you can actually find those programs by state. The program status is still accepting application. You can do self-attestation, allowable on areas of self-attestation and direct to tenant, yada, yada. Because another issue that we are experiencing is that sometimes some landlords are not even willing to accept the rent from the tenant, even if it comes from federal assistance, due to the amount of restrictions that it comes with it. So the programs that you see on the list are actually designed to cater to multiple situations, whether you're dealing with a landlord who's not willing to accept your rent, or if you're a landlord yourself looking for financial assistance, this is also for you, or any other family out there who's struggling to meet month's end and you are desperately trying to seek for help. This is the right article for you. So definitely don't forget to check it out down in the description below. So now back to the tablet, we have another subject that I actually wanted to talk to you about, and it's tapping into your equity. As a lot of you know, the housing prices have skyrocketed, right? It's not surprising. It seems to be a theme over the last 6 months or so. And while that is great news, don't celebrate too soon, because what this article is saying that the home equity is hitting a record high, like I said, but then tapping into your home equity is not an easy thing to do like most people think, because the lenders are actually afraid of repeating another fiasco. They're actually retracting from exposing their banks, their branches, their brand to further risk, and they are making it a lot difficult to get access to a HELOC. And for those who don't know what a HELOC is, let's just take a look at this really quickly, right? So let's say, for example, you have your home right here, and you managed to build up an equity of $100,000 because, hey, you've been very diligent with your mortgage payment, you pay down some of your mortgage, and because of the prices are increasing like crazy, you've actually managed to accumulate between your pay down and the appreciation of the house a total equity of $100,000. So what most homeowners are trying to do is that they're going to the lenders and they're applying for a HELOC. So a HELOC stands for a home equity line of credit. And what it does, it basically works as a credit card, right? So you have your home for $100,000. They usually allow you to do, they don't let you take the entire equity out. So let's say they are willing to issue you a 75 LTV, which is 75 loan to value. And what that means is out of that $100,000, the bank will be willing to give you a credit line of $75,000, right? Because it's 75 LTV. So the way it works with a HELOC is that you will have all of this credit line available for you, but then you don't have to use it all. So let's say, for example, if you want to do some renovations, or maybe you want to buy a second home, but you don't need the entire 75,000. All you need is to take out, let's say, $25,000, right? So literally what you do is you will take just the $25,000 that you need to do whatever is it that you want, and you will start paying interest, and you will start making payments on the $25,000 only. And then the remaining $50,000 is just sitting there in your account waiting for you to come and use it. So that's in essence how a HELOC works. Now, back to this article. What this article is saying is that, hey, more and more lenders are actually tightening their lending standards, and some banks are not even offering a HELOC anymore. But if you still want to be able to tap into your equity and still take advantage of it, what you can do is actually take out a cash out refinance. In fact, it says it right here, because interest rates are so low, your best bet is going to be a cash out refi. Rates are lower than a home equity loan rate and lower than your existing mortgage rate. So for those who don't know, a cash out refi works somewhat similar than a HELOC, but not really. So a cash out refi, we're going to use the same scenario with the house. So you have this house, you manage to have $100,000 in equity, and then the bank is willing to give you a cash out refi for 75 LTV. So what the cash out refi in essence is, it's a mortgage, right? So you have a cash out refi, and the bank is going to say, okay, so your house, you have an equity of $100,000. We're going to give you a 75 LTV, which means you will get access to $75,000 cash. So the money won't be just sitting there waiting for you to use it. What the bank will do is that they're going to take the entire $75,000 and they're going to give it to you. And you're going to start making payments, monthly payments back to the bank based on the $75,000. So with a HELOC, you have all that credit line available as you see here, but you will only use what you need. With a cash out refi, if the bank is saying we're going to give you $75,000, that's all you're taking with you. And then it's up to you to figure out what you want to do with it. Whether you want to buy a house that is more expensive, whether you want to use that money for house renovations, or whether you want to buy a property cash. Although at the rate that the housing prices are increasing, I highly doubt that you can find one. And if you do, congratulations, good for you. But that's in essence what a HELOC and a cash out refi means. And if you want to learn a little bit more, I actually created a couple of episodes that talked about these two subjects, the HELOC and the cash out refi. All you got to do is just to check on the descriptions down below, and you can get access to those videos. So now back to this article, let's continue to scroll down. So even though it is easier to get access to a cash out refi as opposed to a HELOC, there are still some limitations, as you can see here in this article. For starters, most lenders will require that you keep at least 20% equity in your home, if not more, as a cushion in case home prices fail. Just like I explained just right here about the LTV, usually the banks, they don't let you take the entire equity that you have built in the house. They usually like to keep a cushion in there in the bank, and then they just finance the rest for you, right? So that point we're already covered. And again, while the entire industry tightened access to mortgages amid the pandemic, some banks also stopped offering these loans altogether. This is in 2005. You can't pull out every last nickel of your home that you have in before. So in essence, what the banks are really, really afraid is that they don't want to repeat another 2008 fiasco. They're actually tightening up their lending guidelines just because they don't want to repeat another 2008 fiasco. But if you come to think about it, can they? Because at the end of the day, homeowners are very emotional people. They're buying based on their emotions, not necessarily based on numbers. They're not thinking, hey, this house doesn't make sense for me financially, because all their decisions are based on emotions. This is where I picture myself growing older and yada, yada. It doesn't matter how expensive it is. I just want this house, right? And as long as they meet their credit criteria and the income criteria, nobody can actually stop them, because it's in writing and hey, these are the requisites and you're meeting them. But can you truly afford this house down the road in the event that there's a change in your job? And that's what most buyers, most home buyers are actually failing to see, right? So will we have another 2008 fiasco? We don't know. I guess time will tell. Now, moving along, let's diversify our conversation a little bit. But before we do that, if you're enjoying this episode and you're finding it to be informative, don't forget to hit the like button right here and share this video with anyone in your circle who you think will find this information useful for them. Now, moving along, let's just talk about Bitcoin, right? Because news wouldn't be news unless we talk about Bitcoin. So Bitcoin is down almost 50% from a year's high. And this article was actually released on May 23rd, because of course we have to record this episodes beforehand so that the editing team can do their magic and make sure you have a nice video to watch. So once again, Bitcoin is down almost 50% from a year high, mainly for two reasons, right? The first one is thanks to Elon Musk, our Bitcoin millionaire slash influencer, who announced recently that Tesla will stop accepting Bitcoin as payment. And second, because of the announcement that China made on cracking down on mining and trading of the largest cryptocurrency as part of ongoing efforts to prevent speculative and financial crisis. But as we all know, nothing that is related to Bitcoin will remain static. And just like today, we can have Bitcoin hitting all-time highs. Tomorrow, we can have Bitcoin hitting all-time lows, or vice versa. And then only a few days later, after this announcement was made and Bitcoin just went on a crazy roller coaster downhill, we got a new announcement also from Elon Musk, or billionaire slash influencer, announcing that he's having conversations with American Bitcoin miners, and that automatically caused the increase of Bitcoin prices in just a matter of seconds, right? And if you come to think of it, this is actually a great strategy that he is implementing, because as you scroll down on this article, you will see that in an SEC filing in February, Tesla revealed that it bought 1.5 billion worth of Bitcoin and will accept it as a form of payment. So the company later did say that they registered a net gain of 101 million from sales of Bitcoin during the quarter, helping it boost its net profit to a record high in the first quarter. So in my opinion, this is just basically a strategy to just basically manipulate the prices of the Bitcoin. Because if you come to think of it, Tesla is accepting all of this Bitcoin. They're getting a high volume of Bitcoin. And you know what they say, that as long as you hold, you're not having any losses. If you invest, you typically invest in the long run. But let's just face it, Tesla needs working capital. They need liquid money to continue to invest, to continue to improve their product. So a company like Tesla or even Elon Musk, they cannot afford to buy Bitcoin or accept Bitcoin as a form of payment and then just hold it for like 10, 20, 30, 50 years, right? The conventional wisdom of investing doesn't really apply here, because you need the cash today. So in essence, what he did is that he waited for the Bitcoin prices to hit all-time highs, and then he sells it. He made an announcement that sent Bitcoin prices all the way down, taking a nosedive. And then what did that allow him to do? To just simply, cash out on all the equity, use the gains on whatever is it that he wanted to use the gain. And now that the prices are low, he will, sooner rather than later announce that he will be accepting Bitcoin again. He will probably be buying Bitcoin again, just because he had a conversation with American miners and they found a way to mine Bitcoin in a way that is environmentally friendly. And remember, this episode was actually recorded on May 25th. So a lot of things can happen between now to June 1st, which is the day that this episode is scheduled to be released. So don't be surprised if I don't capture something that might have happened in between those days. But as of today, this is what it's going on in the market. Now, moving along, enough about Bitcoin. Let's just talk about Amazon. What's happening with Amazon, and why are we talking about Amazon? Well, we did talk about diversifying our investments. So we started off our episode talking about investing in the real estate market. And then eventually we talked about Bitcoin, because once again, news wouldn't be news unless we talk about Bitcoin. And now it's time to talk about Amazon, right? Because Amazon is nearing a deal to buy Hollywood studio MGM. So here, Amazon is nearing a deal to buy the Hollywood studio MGM Holdings for almost $9 billion, including debt, said people familiar with the matter, a pact that will turn a film operation founded in the silent era into streaming asset for the e-commerce giant. So Amazon is trying to compete with Netflix, is trying to compete with HBO, and then all of the other streaming services out there. And why am I bringing this up? Well, because, hey, this looks really promising for the company. So if you are looking for stocks to diversify your portfolio, Amazon is definitely one of them that you should consider. And for those who might be thinking, yes, Amazon is great, but it's too expensive for me to afford, don't worry. You can actually buy fractional shares of Amazon. And if you want to find out how, all you got to do is just to check the episode down here in the description below, where I talked about the investment platforms that you can actually leverage to buy fractional shares, including Amazon. Now, moving along, another stock for you to consider, it's also on the tech field, and it's Google. So Google managed to come up with a treatment using optogeneric to restore limited visions to people blinded by hereditary retinal disease. So here's an article down here. You can feel free to take a look at it, to, just visit how the technology works. And if you like what you see, you can add this technology to a list of all of the wonders that Google have been creating so far. The search, YouTube, you name it, right? And use that information in your research to make an informed decision and decide whether Google is actually a good fit for you, and add their stock to your investment portfolio, whether through a full share, congratulations, or through a fractional share using the platforms in the video that I listed down below in the description box below for you. And that, ladies and gentlemen, conclude today's analysis. For those who are looking to learn about ways to invest in real estate and about ways to pull all of this information together to make an informed decision, let me tell you that I prepare a free webinar for you to sign up and take advantage of that information free of charge. All you got to do is just to simply click on this link right here that you see on the screen, so you can sign up for a webinar where you can learn how to pick and pull and complete analysis just like the one that I did today at your own time and at your own discretion. So that's pretty much all I have for you today. And until then, I'll see you guys next time. Take care. Bye-bye.